Well, hi everyone, and thanks so much for joining us for this very special webinar. For once, it's actually not around one of the funds that we have for secondary offer periods. It's the strangest bubble, the truth about banking stocks. Now, I'm Tom Wilson. I'm the investor educator at InvestSmart. And what I'll do is I've got Nathan waiting in the green room, so I won't keep him waiting too long, but I'll just quickly run through some important information. And that's that we provide general product advice only. We don't provide any personal financial advice. And always remember that, past performance shouldn't be seen as an indicator of future performance. So don't rely heavily too much on that. That being said, if you've got questions, this is definitely the place to ask them. You can put a question in the question box, and we do see them pop up, and we'll try and go through them as we can. Sometimes we get a lot of them coming through. We're going to upload a version of this to YouTube, but you'll also be sent a link that has the recording automatically for you. So basically, what I was saying before is that Intelligent Investor, in case you're new here, many of you aren't, it offers a very premium service, also a free service too. If you decided to try out the new trial system, you can sign up for a trial just by using your email address. And essentially what we've got here to offer is that experts like Nathan Bell, who we're talking to today, and other analysts like Gaurav Sodhi, they all look at the different stocks, both here in Australia and abroad, and give you very in-depth research using the value investing principles, and also even offer a buy-sell recommendation. And that's not the only thing, though. We also have Alan Kohler on staff as well, and he does his Money Cafe podcasts, plus interviewing CEOs and other bits of information like that. The other thing too is, like I mentioned, for one of the first times, we're not going to be actually focusing on a secondary offer around one of the 4 ETF share funds that Intelligent Investor offers. But I'm going to quickly just mention them because we're talking today about, why the banks are not actually in our holdings here. Nathan will cover off. He's got a lot of slides to go through. Essentially, there's 4 of them. Intelligent Investor, Australian Equity Income Fund. They've all got ticker codes, so they trade on the ASX just like a share, and they all have different objectives. And I'll put this PDF of these slides up on the event page on the Intelligent Investor website, so you can definitely go through at your own leisure. But that being said, Nathan, welcome so much, and thanks for joining us to talk about the banks.
Thanks, Tom, and welcome everyone. I should just, I tend to put these sayings up more for my own benefit than anything, because they keep me sane during these periods of insanity. But this is one that I liked. It's, the banks, we haven't owned the banks in the, I came back to the business in 2018, and one of the first things I did was get rid of the last of the banks in the portfolios. And that's what actually set us up for a run of nearly 40% outperformance over the next 4 years. And then it's been really frustrating, barely even covers it. Value investors always underperform when we get into these sort of bubbly or late stage markets. But for the banks, of all things, especially with their profits going backwards, for them to be part of the bubble and hurting our relative performance has been as frustrating as anything I could imagine. So you tend to sit there and wait and be patient, and the long run things are going to work out, but the short and interim periods while you're waiting can be extremely painful. So I've got this saying in more for my own comfort than anyone else's. So I should just point out a couple of things. Firstly, if you see this presentation on Rask as well, you don't need to watch it twice. The only material difference between the 2 presentations is my haircut. So if you watch this, you don't need to go and watch it again. The other thing is too, this isn't designed to encourage everybody to go and sell their bank shares. First of all, if you haven't sold your bank shares by now, then you're probably not going to sell them anyway. And this presentation is not about trying to convince you to do that. All this presentation is about is to make sure your expectations about the risks and returns from here are right, so that there shouldn't be any surprises from here, given basically how expensive they are. And at the end, I'll go through a few alternatives. But the thing is, there are good reasons why people don't want to sell their bank shares. A lot of people have owned them since the IPOs back in the 90s, so they'd have to pay out big capital gains. And particularly in this market, they can't find an adequate replacement after they pay all those taxes. And that's absolute fair enough. But you should just, I think, particularly for newer people that maybe have bought bank shares in more recent history, or people that are more focused on the value of their holdings and what alternatives there are, and they don't have those 30 years of capital gains sitting there that have to be paid, then I think this might be more interesting to them. But again, I just underline the point that I'm not here to encourage people to sell their bank shares, because for whatever reason they might be very happy with the low returns of getting their dividends, and they don't even care about how the share price moves around. But we are in an extraordinary period for bank valuations, so this is the time to be talking about it and to make your decision about what you want from, what you expect at least from the banks from here. Because we may not ever get a chance like this again to sell them if that's what you're going to do, because as you can see from this slide, we are in a very extreme period, and this is the 12-month forward price to earnings ratio for the market as a whole, not just the banks, but it's actually the banks that are driving that. And you can see that we're just way above. This goes back to 2000, so really around the tech boom and the tech bust that followed. And we've never been here before. The banks have never been this expensive before. And the thing that is just galling to me is that the profits are actually going backwards. And you might say, okay, well, the market's always looking forward, but the return on equity for the banks has been coming down over a long period, partly because of increasing competition, partly because their net interest margins are getting squeezed, but also since the GFC, they have to hold a lot more capital on their balance sheet than they used to. So they're nowhere near as leveraged as they used to be, and that makes them safer, but it also doesn't justify why we're trading at these extreme prices. And I'll talk to you about the reasons why share prices are actually up there. So this is a slide that compares the forward price to earnings ratio for the Australian banks against the rest of the world. And you can see again, we've never been here before. It's just like I've run out of superlatives to explain this stuff. It's just wild. Some people might think, oh, well, Australia's got the most profitable 4 banks in the world and the most concentrated oligopoly in the world, and they're the most profitable, and they've got to come with a bank guarantee and all those sort of things. But none of that justifies this. Actually, what I'm going to show you in a minute is that there are other banks around the world that are just as profitable, if not more so, even than Commonwealth Bank, and they're not trading at anything like these valuations. So this really is a case of Australian exceptionalism. I've got the quote there on the left. When did the banks become AI stocks? I actually remember sitting there 2 years ago and thinking, the banks, maybe, they can probably produce a return of 7.5%. That's without franking credits. I'll just point out that I'm ignoring franking credits right through this. So if you can benefit from them, then typically some people have been able to benefit from anywhere from 1 to 2% a year, and then you need to factor that into your valuation. So you might be prepared to pay a higher price than what the numbers I'm going to show you suggest. But I remember 2 years ago, I think they're not too bad, and maybe we should put them in and we'll get the franking credits. And I was looking at the other stocks and thinking, look, the returns are still 1 to 2% below the long-term return from the index. That means we've not only got to make that up, but we have a fee. Obviously, it's around 1% a year, so we've got to cover that. And so that really puts a lot of pressure. If you had an evenly weighted portfolio that had 25 or 30% in the banks, it meant the other 70% of the portfolio has to work extraordinarily hard to overcome that and outperform the market and cover the fee. And I thought, well, we've got better stocks than that. I just never imagined that the banks' valuations could go this high, and especially with their profits on the whole going backwards, really is quite something. So this is the forward dividend yield prediction for the market, not just the banks, but for the market as a whole. And you can see the impact that the banks are having. We're basically getting now to a record low, and there's 2 reasons for that. It's the iron ore miners have been cutting their dividends as the iron ore prices have been falling, and the other one is just the increase in the share prices of the banks. It's just the yield now for CBA is around 3%. For the others, it's a mix between around 4.5 to 5.5. I think it's the maximum maybe at ANZ. But as you'll see, there's a reason for that. So if you own an income fund, or if you're invested in our income fund and you're wondering why the yield's nowhere near what it was, well, it's just the extraordinary run in share prices over the last 2 years and the extraordinary valuations we've got at the moment from the biggest dividend payers in the index. the way to think about the index is very simple. I always think of it as it's about 20 to 25% is in the iron ore miners. There's another, depending on which index you're looking at, anywhere around from 30 or 30 plus currently in the banks alone. So there's half the market or half the index. CSL's about 7%, and the A-REITs are about 20%. And I'm always happy to be underweight the A-REITs because if you just buy good growing businesses, we can generally do better than them, although Goodman and Charter Hall made the case that's not the case. But for the banks and the iron ore miners and CSL, they're stocks that we sort of hedge to a point. You know, we have a decent sized holding in BHP, although we're always underweight the iron ore miners because I think we can just own better businesses over time. But we do need to have a decent yield in our income portfolio, particularly. So you do need some of those normally, but I thought we could do much better than the banks, but that hasn't been the case over the last 2 years. So here's a look at the earnings per share for the market overall, and you can see that that's been coming down. A lot of that is from the resources sector as the iron ore price has been falling, but you've seen retailers as well at the moment are trading on massive valuations compared to what they have historically. And some of those retailers probably deserve it. They're actually doing quite well. But I just asked the question more generally, with earnings coming down and interest rates having a bit more of an impact on the economy, and we're starting to see even house prices fall, and ever so slightly, but in Melbourne and Sydney. So there is pressure out there, and it just begs the question: should cyclical companies like the banks and retailers be trading on record valuations? I'm not going to answer the question, but answer that yourself.
It's a rhetorical question. I know. Anecdotally, it feels definitely talking to people who are going through mortgage stress, and even the previous Saturday or the Saturday before, we were in Sydney at the ASX Investor Day, and we were speaking to a lot of people who were trying to save up for the home loan deposit in Sydney, and some of them, it just seems like that bridge too far type scenario. But I'll let you get back to it. That's just probably my little rant as well.
I think people have been asking this question for a long time too. Is like, surely these higher interest rates and the high property prices and all inflation, like surely it's going to have some sort of economic impact at some point. And it doesn't really seem to, at least not in terms of wealthy Australians who own homes where the prices have been going up and shares have been going up and dividends have been going up. So it hasn't really affected them. But sometimes you can just be very early. I remember in 2014, we wrote an article in our subscription business about, I think it was called The Coming China Crash. And we said, okay, we think China's economy is going to hit the skids at some point, and at least in relative terms. And here's a portfolio that could do really well out of that. And it was basically just a portfolio of Australian stocks with international exposure. And I hate to think how much that portfolio is up by then. Well, we should have just had all our portfolios just set exactly like that. But interestingly, it's only really now, or in the last 12 months, that the Chinese economy is finally succumbing to that overbuild and now the pressure on the property market where they've overbuilt apartments in particular. I think there's something like 75 million too many apartments, which is mad. But it's 2014 we're talking about that, and it's actually taken 10 years for the chickens to come home to roost. So you can be early with that sort of stuff, but it does seem like there's a bit of pain out there at the moment. So this next slide here, if you're an investor in the US and you haven't owned the Magnificent Seven, or ask any New Zealand fund manager who never owned Zero, or South Africa if they didn't own NASPers, then just not owning those one stocks or a few stocks can really hurt your relative performance. And the chart on the right-hand side shows that we've basically got record concentration in the US in terms of the top 10% of stocks, which is basically the big tech stocks. They're nearly 3/4 of the total index, and they're basically responsible for basically all the returns of the market for the last 3 years. We've actually got something similar now in Australia, where at least one of the indexes, I think over the financials, which is the four banks of Macquarie, are over 30% of the ASX now. So it's an extraordinary situation. And normally when that happens, it augurs poorly for future returns, and it's hardly surprising why. But my guess is it depends on what your valuation estimate is of the banks. But in my view, for them to go back to fair value, it's a 10 to 15% fall in the market that's required. So another way of putting it is saying that the market's inflated by that amount. But we'll talk more about the individual stocks coming up. But again, if you're looking, I think if you're a fund manager at the moment and you've owned a few of the high-flying tech stocks, maybe you've owned Zip, which is up tenfold, or 360 Life, which is up fourfold in the last year. or you're a growth manager and you've just owned, Fisher & Paykel Healthcares and I don't know, ResMeds, Pro Medicus, and these sort of high-flying stocks, you probably had a really good period recently. But if you've owned anything else, which includes us, it's been a real struggle to keep up with the market. And over 5 years we have, but over the last 12 months hasn't been too bad. But sort of 2 years ago, if you include that period, we've had a really tough period in our domestic portfolios. That anything with international, it's been flying. So this is not a title that you really want. CBA, the developed world's most expensive bank ever. It's not surprising. I think it trades on about 3.3 or 3.4 times book value at the moment, and something like 3.8 or 3.9 times tangible book value. For anyone who's new to investing and doesn't understand these terms, it doesn't matter. You don't need to. All you need to know is the chart there and just see how crazy the valuation is. And again, normally when you go into a bubble, it's some sort of new technology or a new growth area or growth industry or something where either people are coming in to try and get rich quickly, or there's just people to see growth for the next 10 or 20 years and just want to get on board. Essentially it's the same thing. But what's crazy about this particular bank bubble is the earnings are going backwards. I just can't underline this fact. Like I think it was, I can't remember, it was ANZ's profits actually went back 8% this year. Which is a huge number. Like normally the share price would fall 20 or 30% if that was a growth stock, or ResMed earnings haven't even been affected in the last 12 months, and yet the fears around the GLP drugs, the share price fell nearly 50% or 40%, and yet these banks are reporting falling earnings, and yet their valuations just keep going up. It's really crazy. So here's another slide. This is basically the same slide as the international comparisons from before, and it just shows the valuation of Australia's banks compared to the rest of the world. And you can see essentially the Australian banks are on another planet compared to the rest of the world's banks. And again, I'll just repeat what I said before. It's not because they're more profitable than the rest of the world banks. There's actually banks that are more profitable than some of our Australian banks. And I'm going to talk about some of the reasons why the Australian banks are getting bid up in a moment. This is one difference from the presentation I did with Rask. I got this quote in my inbox. It was just yesterday, and this was a quote about US banks. So just bear that in mind when I go through these numbers in a second. But it says valuations on US banks are at levels where recent history suggests a steep price decline is almost certain. All right, so just keep that in mind when we get to JP Morgan in a second. So what I've done for you in this table is I've put in basically the CBA of other countries. So Lloyds is the CBA of the UK. ING, you might be familiar with that bank in Australia, but more of an online bank. I think they're actually the 5th biggest bank in Australia, but a very good European bank. Hangs out around the Netherlands. And JP Morgan, which is widely regarded as the best bank in the world. And what I've done is I've compared the return on equity for the 4 of them, and you can see they're all, Lloyds is a little bit under, but ING's is basically in line, and JP Morgan's is even higher. And then I've compared the valuation statistics using the price to book value. Again, if you don't understand that, if you're new to investing, don't worry about it. Just just concentrate on price to earnings ratio. It tells the same story. And I've compared the yields as well, but there's difference in the yields partly because of different cultures. In America they tend to buy back shares rather than pay out dividends. But the point is very clear. You've got Commonwealth Bank. I've got their trading at 3.6 times book value, but I think it's actually 3.4 times book value and 3.8 times tangible book value. And the PER there is a whopping 26, which is just huge. And the 26, I think this is the first time that CBA has actually had a higher price to earnings ratio than CSL. And CSL, even though it's not as profitable or not quite as good as business since it made the big acquisitions of Viffles or whatever it's called a couple of years ago, which has really hammered its return on equity. Still, the earnings per share growth from CSL is potentially double digits, or at least high double digits, and CBA's growth is basically 0 at the moment. So it's quite remarkable. And you've got the yield there of CBA is 3%. I'm not sure what the yield on CSL is at the moment, but it's probably 1.5 or 2%. So you're not actually giving up much yield. Although I'm not sure if because CSL earns a lot of its earnings in America, maybe they're not all fully franked. I couldn't tell you off the top of my head. But anyway, so if we go on to Lloyds, look at the astronomical difference there between the valuation. It's less than a third. of Commonwealth Bank, and yet the profitability is not much difference based on return on equity, and yet it's got a yield that's nearly twice as high. ING, again, same thing, just remarkable, and yet the yield's 150% higher than CBA's. Obviously doesn't include franking credits. And then you got JP Morgan, which is the world's best bank, higher return on equity by quite a bit, and yet trades at nearly half the price to book value and half the price to earnings ratio. So if people in the US are saying there's potentially big declines coming in the US banks, what the hell does that mean for Australia's banks? So this is probably my favourite slide in the deck, because this shows you who's actually been buying the banks, the Australian banks, and who's been selling. And normally we talk about, when we get in these bubbles, we talk about it's usually people who are just coming to the market to cash in on the quick returns at the end. And normally that's referred to as the dumb money. But Australian investors, individual investors, are actually the smart money. So I think this is really encouraging, but as a professional fund manager, I probably shouldn't be so happy about it, because it means people are getting smarter, which is making our life more difficult. But you can see that people have actually been cashing in on the bank share prices, which is just great. And the people who have been buying there's two groups. There's domestic institutions, which is basically the industry super funds. So if you've seen those, those compare ads, shop and compare, or whatever the line is on the TV, and they boast about the 9% returns. Well, you've got to wonder how they're going to get 9% returns when they've just got these massive portfolios full of banks, which you're going to be lucky to get a return of 5%, again, excluding franking credits, per year for the next decade. And that's if everything goes well. And that's a point I can't stress enough when I talk about the numbers in this slide deck, is everything's based on profit at least remaining stable and nothing going wrong. I don't actually talk about if actually anything goes wrong. If there's a recession, or bad debts go up, or interest rates get cut by 3 percentage points and the profit margins collapse again. None of these things. And you can
trade wars.
Yeah, absolutely. There's just so many things that could go wrong that just aren't getting, no one's worried about at the moment. The domestic institutions, the reason that the big institutions in Australia are buying the banks is basically because they don't want to be exposed to China. The two big parts of the index are basically the iron ore miners and the banks. And so no one's wanted the iron ore exposure. And so that's why the money's all going into banks. So you can understand it, but it tends to not make a lot of sense when you look at the future returns. And then you can see that there's also the international institutions, and particularly over the last 12 months, they've been doing the same thing. And it's actually not surprising, because a lot of the Asian funds actually see Australia as a safe harbour. Our market is far less volatile than most Asian markets. So the banks are considered very stable, very safe place to invest for them. So they've been looking for somewhere to hide from China as well. And so it's hardly surprising that they've been buying the banks. But the key point is it's not fundamentals driving this bubble. It's just essentially people trying to escape China exposure or escape iron ore exposure. And again, it's really cool to see the Australian investors capitalising on what could be a once in a generation or once in a lifetime opportunity to cash in on these bank share prices. This is just a slide that shows the retail ownership of the banks, and it just reiterates what we've just seen on the previous slide, which is CBA's retail ownership has fallen below 50% for the first time since 2011. And you can see there it's not just CBA where the retail ownership has been right across the banks. I really like this slide because I'm going to tell you something about why these... what it shows you in a second. So I'm just going to read off the slide first. So it says, Macquarie notes domestic institutions were significant net buyers of most banks in the June quarter, and I think you can make the case ever since as well. Overseas domiciled institutions were also net buyers, interestingly. Macquarie also points out that the index funds were responsible for much of the flow. So there's been a lot of debate about the impact of passive investing and ETFs on the Australian market. A lot of people saying it's not actually ETFs buying the banks, and Macquarie are saying actually, and they should know because they handle the flows. They're actually saying, well, actually, yes, it is. And to me, it just makes intuitive sense that it is a lot of that buying, because once these share prices go up, basically all the passive funds have to buy more shares because they have to keep reweighting to the market. So essentially, it's almost a fight up to buy shares. And I think it's going to be really interesting to see what happens on the way down, when all of a sudden these index funds are actually fighting themselves to sell the stocks as they reweight. And I think we actually got a bit of a glimpse in that. I think for anyone who remembers 1987, Black Friday in the US and Black Monday in Australia, where the market opened up 27% below where it was on Friday. And that was really, as far as I'm aware, was the first time technology was used to make trades. Essentially, the algorithms acted independently. And it was the first time we saw portfolio insurance. And basically what the portfolio insurance said, or the computer said, was that if the market falls by a certain amount, then we need to sell a certain amount of our portfolios. So you can imagine what happened with all these funds who had these set up thinking they were doing the right thing to protect their portfolios. They were just triggering more selling and more selling and more selling. So that's why the fall was so rapid. So I think you never know with the share market. Like when bubbles, they don't always pop. Sometimes they just deflate over a decade. And I'm going to show you some examples of that in a moment. But sometimes they do pop. And if the banks were to pop, then I think it'll be, maybe the best analogy is how fast shares fell when COVID came. Like you really only had 1 to 2 days to really take advantage of those cheap share prices, and then all of a sudden the market went back up. So I think that's potentially what, like, obviously we don't know until it happens, but that's just one thing to keep in mind, that when the share prices do fall, maybe we just get 10 years of nothing, or we get a really fast fall and the bubble pops. So you just need to be ready for that, depending on what your strategy is, because you actually want to be able to take advantage of that. So you might have to think very quickly. But two things I want to point out about this is, first of all, CBA is now 10% of the index, and that's augured very poorly when CSL and BHP have achieved this feat. CSL is actually still, I think, 10 or 15% below, or 10% below where it was when it achieved that feat 5 years ago. And everyone used to just, like, all you ever used to hear about 3, 4, 5 years ago was CSL and how much money everyone had made out of CSL. Now no one wants to talk about it anymore, and the share price has gone nowhere for 5 years. And I expect that's the same thing is going to happen with CBA and the rest of the banks. Interestingly, what this chart shows on the left-hand side of it, the domestic institutions have eschewed buying ANZ, and then they've bought the banks basically compared to their quality. So CBA is the highest quality bank, followed by NAB, followed by Westpac. And then you see the offshore buying, and actually you can see they don't really understand the nuance in Australia. They've actually just been buying the cheapest statistical bank, which is ANZ, and that's been a very poor trade, basically forever. So it's interesting. Just another example is, every now and then I see this when an American investor comes to Australia. And in Australia, we get very used to companies having a balance sheet problem and then just taking the hat out and saying, we need more money. Can you support us in a capital raising? And they dilute shareholders. But as Australians, we think that's pretty normal behaviour, and we tend to support them. In America, they absolutely hate that. They hate the dilution. And that's why you see companies in the US are very highly leveraged, because they tend to think they should be able to earn their way through it. And also, they don't rely on a bank debt as much as what we do in Australia as well. So they tend to have a lot more longer funded, lot more longer matured funding in US credit markets. So they actually have a bit more time to get through it. They don't have the pressure of the banks telling them, you either raise money or we're going to take the money off you and essentially force you to collapse. So that cultural difference is really obvious here. Now, Australians know that CBA is the best bank, and it's been the best bet forever to stick with the highest quality, and yet the overseas investors, and you can see their impact they've had on these bank valuations, and yet they're actually buying the cheapest one, thinking they can actually make some money out of it, which just has never seemed to work at ANZ. So what have we got now? That's the question. So what is CBA now? Is CBA the new Woolworths? So back when I joined Intelligent Investor in 2006, I think I actually had a buy with a bit of a help from a mentor back then on Woolworths. I think it was below $24 and it went up to $30 and actually kept on going. And I see the quote there, 3.5% dividend. I think it's lower than that. I'm pretty sure it's 3.1 at the moment. But at the point is absolutely right. So Woolworths, the share price at Woolworths currently is now below, in fact, well below where it was back in 2007. So my question is, is that what we're going to experience from CBA? And you can see there, it sort of, not huge falls. I guess it fell by a third a couple of times, but it sort of just wriggled along. But all of a sudden you look back and it's been 18 years and all you've got is the dividend yield, which I don't know what the average dividend yield would be, might be 3%, 3.5% or something like that. And you've actually wasted a decade of returns. Like, imagine if you sold Woolworths at those highs back then in 2007 and bought REA Group instead, or CSL, or any of the great quality growth companies. Like, you would have made tenfold your money, or way more for some of those stocks. My other question is the new CBA the old CBA? So if you had to own, you can see if you own CBA again at that same point we're talking about with Woolworths just before the GFC in 2007, it was trading at $60, and you had to wait a decade just to make about 30% in capital gains since then. So pretty low capital gains when you could have done much better buying everything else. And then you might make the argument and say, okay, well, I've actually done all right if I hung on to CBA because it's gone from 80 to 156. But the problem I've got with that argument is you're relying on a bubble to get you that return, and you can't sit here. This is the reason why hardly any fund managers have owned Pro Medicus, is it's just always looked crazy expensive, and it's at 200 times earnings. Like, as an author in the Fin Review put the other day, which I thought was a great line, he said, there's no spreadsheet in the world where you put in an extra $20 million of operating earnings and it creates $2.5 billion of value, which is what happened with Pro Medicus after it announced a $300 million revenue contract the other day. So, you really don't want to be sitting there waiting on bubbles to get your return. You just got to be more realistic, and it tends to work out over time. But that's the question for CBA. Are we actually going to get a decent fall at some point, and that takes it back to fair value, or do we just go nowhere for the next 10 years? And if you're going to own the banks, you just have to be okay with either one if you're going to hang on to them. That's all the point is. I do want to point out a few differences, though, because I think a lot of people would say, okay, I understand that, and you know what, I'm happy to get my 3% dividend yield from CBA, even if it doesn't increase, there's no earnings growth. And if the share price falls by 30 or 40%, I don't really care, as long as the dividend keeps coming, because I don't want to pay a big capital gains bill, or I can't find appropriate replacements, and that's all fine. But I just want to point out these differences compared to 2007, because remember, through the period of 2007 to 2017, 2018, the bank's earnings per share in Commonwealth actually increased 50% through that period. So you actually did have earnings growth, and yet you still hardly made any capital growth out of the stock. And this time it's actually worse than that, because at the moment, no one's expecting any growth, negligible at best. The competition is far more intense now than what it was back in 2007. So Macquarie, for example, is eating their lunch. You've got ING, who's the fifth biggest bank in Australia, and technology is changing. And because of that, and also sort of as part of that, is you've got brokers sourcing about 75% of loans these days, which means the profitability of the bank's mortgages is less because they've got to pay the brokers who source the loans. So things are actually different. And in fact, all these differences are actually all negative. I haven't even mentioned, the big IT spending or software projects, and what effect is AI going to be? As a nice line from the CBA chief in the Fin Review the other day that said, are you at the table for the changes, or are you being consumed for lunch?
Well, there's actually quite a lot of questions that were submitted before the webinar talking exactly about that. So I'm not sure if you want to tackle that now or a little bit later on.
Yeah, look, the AI thing, again, Matt Coman's quote, you said, are you on the menu, or are you going to participate in the change? It's the way I tend to think about this, and doesn't necessarily mean it's right, but these step changes in technology generally have a bunch of small winners. So if you think about the change to the internet, essentially the old classified, newspapers and stuff all didn't go out of business, but are all hemorrhaging. And then you had this birth of a handful of new great companies like the REA groups and car sales and whatnot. And for everyone else, the internet essentially just reduced their costs. So it's an efficiency-led gain, if you like. I think the same thing will probably be with AI. And again, I'm not an expert on this stuff, and I don't have the inspiration to think of all manner of things that a lot of other people would. But the way I think of it is, for a lot of companies, it's going to reduce their costs, but it's going to reduce costs for everybody. But there are also going to be a whole bunch of losers, and they're going to be a small handful of winners. And we're already starting to see some of the winners, whether it's NVIDIA or whatnot. But there isn't actually many direct winners so far. And maybe business models will adapt, and we'll find the new REA groups and new car sales, but they're not particularly obvious at the moment. But if you think about what a bank does, all a bank does is really, although it does it digitally, all it does is just approve loans. It just stamps the paper and says, yep, that's fine, and moves the money. So if I was to think of something that AI could do very easily and the internet and other services could do really easily, I would have thought that was it. Now we're in an era now where everyone has so much more data that if there's any competitive advantage to writing loans and making good loans as opposed to bad loans, I think all that data is more available to anyone than ever before. The one thing that's actually, we've seen all these payments companies that are down, 90%, 80%, 70%. Some of them recovered a little bit recently, but a lot of those, neobanks, if you want to call them that, one of their biggest problems was they were absolutely able to cut you a lower cost loan. But the problem is when you lend money, you've actually got to have certain capital behind you on your balance sheet, like it's regulated capital. And the problem is they could make all the loans, but they just never had the capital base to compete with the banks. So what they relied on was other debt forms, a bit like RHG back in, during the GFC, they similar, types of funding sources that have to be renewed every few years. And if you go through a bad period in the market or credit's a bit tight, all of a sudden that completely undoes your business model. And because all the banks do really is take a margin on between what they lend at and what they borrow at. But it's that huge capital base they've got that allows them, it's the huge advantage over any of the neobanks, because there's only, having a deposit base there as your source of funding is so stable, rock solid, and people don't tend to change their deposit banks very often because it's a pain in the bum and there's usually not too much advantage to it. But even that's breaking down a little bit because it is getting easier and easier to move your money around and take advantage of better rates elsewhere. So I'd say basically everything that's happened for the banks over the last 15 years has been negative, and yet we've got this paradoxical situation where their valuations have never been higher. So I've done some maths for you here. And again, if franking credits are worth 1 or 2% to you, or maybe you don't need to earn a 10% return, you're happy with 5% or whatever, then you need to adjust these numbers accordingly. But I think it's a pretty conservative thing to ask for a 10% return on the banks because of all these threats to them. And they are cyclical. We haven't really seen it. Bad debts are at probably record lows at the moment or somewhere down there. They really haven't had a problem. But so what I've done, and again, as a professional fund manager, we need to be outpacing the market. So we can't accept a 6% or 7% return because it guarantees we're going to underperform, and no one's going to invest with us if we guaranteed to underperform. So this 10% might be a bit arbitrary for people, but I think it's the minimum that we would want to invest, or at least somewhere up there anyway. But our income fund, maybe if it was 8 or 9%, we get the franking credits, we might buy some, but you get the point. So what I've done is I've worked out for each of the 4 banks, based on their current return on equity, what you would need to pay, or how much the share price would need to fall to give you a 10% return. So again, maybe for newer investors who aren't familiar with return on equity and book value and all that stuff, just ignore it. But there's another way I can show you. It's much easier to think about this stuff that just reinforces these numbers. So I've done the numbers for you. So for CBA, the share price would need to fall over 60%. For NAB, it's over 40. For Westpac, it's over 40 or 40%. And ANZ, it's just under 30. But again, there's a reason why ANZ tends to trade much cheaper than the other banks. Probably haven't got time to go through that today, but if anyone asks. What I actually think is quite interesting about this table is if you have a look at the book value. So again, this is the shareholders' equity, or the accounting shareholders' equity, or net assets, which you can just go and look up in the annual report. You actually see that it's almost exactly the same for every bank, and yet the amount of profit that they wreak out from that capital base or asset base, it's just so much higher for CBA. It's really interesting. And it just shows you the differences between their business models, and the fact that in a game of scale where the biggest is usually the most profitable, is a huge advantage, and that's what CBA does best. Again, return on equity can change. Basically the return on equity equation is just net profit over your net assets or shareholders' equity. So if the net profit was to increase and the return on equity was to increase, then you wouldn't need the share price to fall as far to get back to the 10% return. But I feel like we're at maximum profitability for the banks. And the one thing that might change for them is if interest rates were to go up, that helps profit margins. But the problem is on the other side of the equation, if interest rates go up, then credit growth tends to slow and people borrow less money. So that's why low interest rates, people tend to think, that must be good for the banks because people are borrowing more, but it actually reduces their profit margin on each loan. and deposit, when you compare the two, so that margin gets squeezed. So again, if it's valuation that you think about, you probably sold your bank stocks already, but I think it's important to know that if you are going to hang on to your bank shares, no matter what, then at some point you probably like to get a share price for at least something similar to this. And if you don't care and you want your dividends, that's absolutely fine, but just be ready for it. Again, I just got a chart here. I got this, I think this is about, September 5, so it's actually a couple of months old. This isn't a record. This is basically the variance between the banks and the resources value stocks on the ASX and their valuations. And this, please don't make the mistake that this chart here is to tell you to sell your bank stocks and buy iron ore miners. That's not what it's doing. It's just a relationship that tends to hold pretty steady over time. And you can see in the last 12 months, it's actually been blown apart. And it's all because the bank share price have gone up, not because the iron ore miners have gone down that much. And that's not a record at in this chart, but I believe last week or the week before, that spread got to 66%. And I believe that is a record, ever. So again, we're witnessing history. Just got this quote because I think this is really important. And people always think, oh, well, the Australian market's different to the US market. But this is why Australian fund managers tend to wake up every day and see what's happening in the US, because this is a quote from a couple of UBS analysts, and they say valuation multiples on Australian stocks are most influenced by shifts in the multiple on US stocks. Put simply, when valuations on US equities expand, so too do Aussie stocks. So that actually makes no sense in one sense, because it just means people aren't focusing on fundamentals. It's basically just telling you that when animal spirits are pushing up valuations and share prices in the US, we have animal spirits in Australia as well. So it's completely understandable. But when share prices and bubbles are being created not based on fundamentals, that's when you actually really need to do your homework and make sure you're prepared for whatever comes. So I've got these additional couple of slides in. These actually weren't in my presentation from a couple of weeks ago, but I don't think. But basically, the question is, where is the value? And at the moment, while the most expensive stocks are the most expensive in history, the cheapest stocks, by comparison, are the cheapest they've ever been, just about in history outside the GFC. So there is value there, but if it's a case of you wanting to replace Commonwealth Bank, for example, with another similar type of business, then yes, that's much harder in this environment. But what I would say is, don't always look at the current environment and assume that's the only environment you'll ever be able to make choices from, because things do change, and they can change fairly quickly, and sometimes you really have to be patient, but things do change. Bubbles don't last forever, that's for sure. I've got this chart here. This compares the top 5 stocks in the US versus the Russell 2000, which has all the smaller stocks in it. And I'm just going to give you a couple of quotes here, because this is, I think, a really, there's obviously a chance that the bank bubble and maybe the bubble in quality stocks just blows up and the market falls 30%. So I'd give that, I don't know, let's say 30 or 40% chance at some point. But maybe the other big one is, another 30, 40% is possibly this scenario. So I'll just read straight off the slide. So it says, the top 5 combined market cap stocks is now 3.3 times the size of the entire Russell 2000 index. So just let that sit there for a moment. So you can buy the Russell 2000 stocks, which obviously does include a lot of crap and a lot of businesses that aren't making any money. But just 5 stocks are now worth 3.3 times those 2000 stocks. So if you think that's unique, that is more than 2 times the level in the tech boom. So it just shows you we are, in an era that has never been seen before. So reading to the second paragraph here, so this is what happened afterward. So from 2000 to 2006, small cap value stocks had annualized returns of 16%. Right? So, more than, if you compound that, it's probably about 120 or 130% return over that period. And you compare that to the S&P 500, which was closer to 1%, and longer duration equities, which is your growth stocks that trading on huge valuations, they actually generated negative annualized returns. So I'll give you one example. Is up until about 2016, Microsoft's share price had gone nowhere since 1999. and yet I think earnings per share were up fourfold through that period. So the business did everything perfectly, and yet you made no money. And so whenever you'd see a value investor do a presentation, they'd always talk about the risk of overpaying for a great business. And Microsoft was always the example they used. But Microsoft's earnings per share went up fourfold through that period. You still made no money. But at the other end of that 16-year period, they actually discovered Azure, the cloud storage business. And that's been a huge growth for the business. And now you've got AI. So that business was essentially reignited. Now, CBA, just as an example, is not going to grow its earnings per share 4 times over the next decade, and nor is it going to find some magic business at the other end of 16 years that's going to propel its earnings again. So, it wouldn't surprise me if this bubble just essentially deflates over a decade and, you don't get the cataclysmic fall. But I think either way, you just have to be prepared for it and just make sure you're comfortable with it. This is a slide which just shows the valuations of the banks and versus the resources sector, because that's really where we've had a tilt. We don't generally own a lot of resources stocks, but we've definitely had a tilt towards them in the portfolio. We made a lot of money out of the coal stocks a couple of years ago when we were absolutely flying. We should have just sold them at the peaks, which would have been better. And obviously, anyone who's following us, we've had our problems with MinRes, and our coal stocks haven't done anything recently. We've had a core holding in BHP, which hasn't done much, and we've had a tiny holding in PLS for the lithium exposure, which hasn't done anything. But again, it's not a big exposure. But just having that tilt towards those resources stocks and not owning the banks has probably cost us about 20% in performance in the 2 years alone. So that can reverse very quickly when it turns. But the question I get asked the most is, well, what's going to change for the banks? Why are they going to fall? Like, where's the money going to go? And a few different scenarios. I think, well, one, you could just have a general fall in the market, and that's maybe when we get all those ETFs battling each other to sell the stocks. That's one strong possibility. The other one is there isn't a lot of selling, and maybe they just sit there for the next 10 years, and the industry funds just keep putting 10% of your superannuation in there every quarter. It could be that we actually get more comfortable around China, and maybe the iron ore miners start getting the flows back from the banks, which is they've lost over the last year in particular. And I think that would be also the case that foreign institutional money that's been another large marginal buyer of the banks, that money will disappear as well. But again, I don't know. It just could be 10 years of nothing. And again, this slide is not to tell you to go and sell your banks and buy iron ore miners, because we're underweight iron ore miners, and the iron ore miners are not going to have a paradise like they've had in recent years. There's more supply coming, and China doesn't need anywhere near as much iron ore as what it did. So again, just to be very clear, don't sell one for the other, but the relationship between iron ore valuations or resources valuations and the banks tends to be fairly steady over time, and you can see the relationship's been completely busted at the moment. So I just thought, again, I'm not telling everyone to sell their bank shares and buy these stocks, but I just thought I'd talk about a few stocks in our funds which haven't been doing a lot, but to me that look like good value. And this is what we own as compared to the banks, and hopefully it pays off at some point. So New Hope Corporation's a coal stock, and I can absolutely understand why people don't want to own a coal stock, but it's paying at the moment at least an 8.4% fully franked dividend yield. So you actually, if you can use the franking credits, you're getting a 10% annualized return just from the current dividend alone. And once it completes its expansion at Bengalla, and then potentially you've got a free option on higher coal prices at some point, that could do, potentially this is a stock that actually could do 15% a year if everything works out and coal prices go up at some point, maybe even higher. I mean, the share price is around $4.50 at the moment, and I think in our subscription business, I think the sell price is $8 or $9. So you could collect this dividend, and the dividend could go higher, and you could potentially double your money in the bull case. So to me, that's a much better place to be than the banks. But there are risks, obviously, and again, we might be wrong. MA Financial is one that I've had in the funds for a while, and I've preferred this over Macquarie. Like the risk between the two is much different. Macquarie is obviously a much more stable and reliable bank than MA Financial, but to us, Macquarie looks expensive, and we've actually got to sell on it at the moment. The bank, it hasn't done anything wrong. It's just very expensive for the amount of growth it's got to offer. But MA Financial is like again, I don't want to compare them on a risk basis, but in a sense, MA Financial, which is a sort of similar business, this is basically like buying Macquarie in the 80s. So earnings per share are potentially about to increase 50% over the next 2 years. It's already trading on a 3.2% fully franked yield with, and they do put up their dividend very fast when earnings go up. So they're very shareholder friendly in that regard. So that's one I preferred, but again, the risks aren't the same. So it's not a 1-for-1 change, but this is the one. It's been essentially been bid down for, it's been doing nothing for the last couple of years. It's spent a lot of money investing in parts of its business, and those investments are finally starting to pay off. Again, it could be very volatile in the market fall, but in terms of where, if nothing goes wrong and things work out, it's this could easily be trading on 20 times earnings in 2 years on nearly 50 cents of earnings per share, which would be $10 and a 50% increase with plenty of growth to come. Imagine if it traded on 27 times earnings like Commonwealth Bank, it's more than a double. Eagers Automotive, again, it can be a cyclical business at time, but it's currently yielding 6.6% fully frank and hasn't missed a dividend since it's been listed, I think, in the 50s. It's a well-run business, doing everything right and just ambles along. Chorus is the fibre optic network in New Zealand, and it's currently yielding around 7%, but we think that can go higher. So again, they're not 1-for-1. I can't tell you that this is exactly the replacement for CBA, but just in terms of how we're constructing a portfolio that we think can do really well in the future. And if you take, it's not just the banks that are in a bubble, but the Shaw and Partners have a nice little model that I see every month or so. And they try to estimate what the forward return on the market is. And at the moment, they're saying the yield on the market is 3.2%, but they're actually thinking there'll be a small fall in the market to get you to a 2.9% annualized return. So it's not just banks, it's just the market in general is really expensive. So, I'm sitting here as the portfolio manager going, really frustrated at, we outperformed by nearly 40% between 19 and 22. And then we've given most of it back, if not all of it. And we haven't really done a lot wrong. We had a few mistakes a couple of years ago, but don't really feel like we've done much wrong for a while. And yet our portfolio's just been left in the dust. And you're asking, why is that the case? Well, we're buying these stocks and we think they look cheap, and we're trying, absolutely, we don't want to be sitting here telling people we're going to earn 3% for the next 10 years. We want to at least be earning 8 or 9%. And if that's the case, then we'll absolutely flog the market, and hopefully the banks come down and the growth stocks come down to more reasonable levels. And all of a sudden now, the underperformance over the last couple of years will turn around very quickly. And this is how we expect to do it. I just can't give you any, I just wish I could tell you the timing. Karoon Gas is a little oil company. And again, not a 1-for-1 swap by any means. It's only a small position in the portfolio, about 3%, but it just keeps going down as the oil prices come down. But thankfully, Samuel Terry got in there and changed the incentives at the board level and management level, and they started paying big dividends and buying back shares. And so this stock looks extraordinarily cheap. And it's a stock that maybe when oil prices go back up at some point, you could make 3 or 4 times your money. And in the meantime, you're getting this dividend yield. So it looks all right for us for a small part of the portfolio. But again, it's part of that resources crew or tilt in our portfolio that's just done nothing for the last 2 years, while growth stocks and bank stocks have just gone to the moon. And then the last one, Endeavour. I think this business really needs to get a good CEO and start cutting costs and getting the margins going. But it's actually hit a record low last week, but it's yielding 5%. And so if you get a manager in there, can actually do something decent with the bank, with the business, then if you can reignite earnings, then maybe you could get a 10% return plus. But again, it's one that's out of favour, but probably deservedly so at the moment. So that just shows you, like, that the world, the investment or the stock market world out there isn't completely bereft of good, decent yielding stocks. But I just can't say that on the individually, it's not the same as sacrificing the banks. They're probably not as steady, and there's probably more. Obviously, there's more volatility. But if you're looking at a more portfolio level, then there's plenty of options out there to construct a really nice portfolio. I think for the next 10 years, it's not going to give you sleepless nights and still give you a good return, and actually has the upside. Whereas, for New Hope Coal, for example, if coal prices go up, you actually might have some massive capital gains on that as well. MA Financial, if earnings per share does grow 50% in the next 2 years, that's not the end for MA Financial. What's Macquarie done over the last 30 years? And maybe that's the future for MA Financial. And then the other business will just tick along. And if resources actually coming back into vogue at some point, because they've been hated for a while, and they're, as a group, I think they're almost at record lows versus just valuations generally. They come back into vogue, potentially there's some big gains there for us. So I think that's pretty much it. There's just a slide going through some of the basics of the funds for anyone who's interested. And the one thing I just always highlight with the funds, because people do ask, is because they're listed, people look at the stocks that are listed and see maybe there's not many units traded on a day. And that doesn't mean the funds are illiquid. It just means the supply and demand for the stock on the day is low. The funds are actually subject to ASX liquidity rules, and I assure you they are very tight and they're very painful, and they're the bane of my existence.
Yeah, I think we cover them off usually in the secondary offers about how liquid they are and how they are the bane of your existence, the liquidity rules. But there's also the link there. There's the QR code. If you're watching this on YouTube or something bigger screen, you can actually take a little QR. We all know how QR codes work, unfortunately, but it'll take you to the funds overview page where you can actually see the 4 ETFs that Nathan's been talking about. And I guess that brings us back to the whole point is that, we're talking about the banks. Nathan's saying, this is why we don't hold them. And I guess the alternative there, there's the 4 different ETFs that we have. Nathan went through a lot of the alternatives on that previous slide, talking about Karoon and Endeavour, MAF as well there. There's a lot of questions though, Nathan, talking about Macquarie. I know that Nick Cummings, one of the analysts, did put a sell recommendation, I think it was back in July, on that one, but also talking about Bendigo. Do you see any opportunities with the smaller banks, Macquarie? There's Suncorp as well.
Yeah, the thing, so Macquarie is a great business, and I did discuss it briefly, but again, you can apply the same exercise as what I did with the return on equity for Macquarie, and to us, it just looks expensive. Again, the business hasn't done anything wrong. It's a great business, and I actually wish we could go back a couple of years, and I think in future, we'll probably just hold a key position in Macquarie, so we don't have to go through this sort of underperformance from the banks, at least have a couple of financials in there. Because it has been quite frustrating, although, we may never see a bank bubble like this again, and it may not happen again. So, but the smaller banks, the regional banks, I would never buy them personally. I just think they're too risky. The return on equities are inferior. All the big news that comes from them seems to be bad. They're just in a bad spot. They can't compete as well as the big 4 banks. So I would, when it comes to banks, because they're so highly leveraged and they can be cyclical, although you sort of wouldn't know that so much in Australia because we haven't even had a recession since I was at high school. You just want to stick with the quality, and the quality tends to work out over time. So CBA, it's always been best to be in CBA and, give up, in a sense, you think you're giving up a bit of yield, compared to, say, ANZ or something. But when you own it over decades, you actually get a far superior return owning the best banks. And CBA is easily the best bank in Australia. And NAB, under Ross McEwen, although he's not there now, but he did a fantastic job turning that bank around back to its, I think it was the late 90s. NAB was considered the best bank in Australia. So, I would stick with them. I would never buy the regional banks. They look cheap sometimes, but they're cheap for a reason. And just over time, and it's the same thing. I wish 2 years ago we just bought some of the higher quality stocks and made our life much easier and not tried to be so esoteric with our ideas. It just would have worked better. It's a harder decision to make today when valuations are so high for the really high quality stocks. And I think that's what's frustrating for a lot of bank investors. It's like, well, if I sell, what do I do now? But again, the market is what it is. You can't change it. What's the saying is you can't control the wind, but you can adjust the sails. But don't let just today's environment think that's the only environment that ever exists, because bubbles do tend to deflate over time and new opportunities pop up. There's always 2 or 3 opportunities every year. Might not be exactly what you want, but you've just got to make the most of what opportunities there are.
Yeah, that's definitely the case. I know that I find myself getting caught down the rabbit hole of the recommendations that come out at Intelligent Investor, because there's always so much in-depth analysis that's done by the analysts, because most of them are, big believers in the stocks, aren't they? Like they put their money where their mouth is, so to speak. I remember going back, I think one of the very first webinars that we ever did And I remember you were talking about dividends and coming from the banks in particular about how banks should always pay out their retained earnings or their dividends. They shouldn't be, I think the term you used at the time was they're not responsible enough to go and make their own investments. I think you were talking about how ANZ invested overseas, and it was also one of the other banks invested in the UK, didn't they?
Yeah, NAB had a big one.
Nah.
That's really behind CBA's success. It is the biggest and therefore the most profitable. And a key measure for working out who the best business in an industry is if you can reduce your prices and still have the highest margins in an industry, you are by far the best business, and you want to own that business and pay the premium for it. But NAB fell for it. They made a big overseas acquisition a long time ago, and that stopped it from being the best bank in Australia. And it's taken nearly 30 years to recover, 25 years or more. CBA, again, it just hasn't fallen for any of that stuff. Westpac, things have just gone wrong in there. I think since probably the St. George acquisition, it just hasn't been the same bank properly since then. And ANZ are always coming up with some new way to waste money, whether it was Mike Smith's terrible. I actually like listening to him, but the strategy to go and take on Asia's biggest banks and buy them with acquisitions was just foolhardy. Why on earth would you want the Australian banks diversifying overseas? There's no way they can recreate the advantages they have in Australia. It's a bit like REA Group. People, the share price has gone up, I think probably 20% since its bid for Rightmove in the UK didn't go through or wasn't accepted, because it's the perfect business. Like, why would you want to stuff it up? And so this is what happens with a risk. Again, this wasn't on my list of risks with the banks, but management and boards do stupid things at times and blow up money. That's why no one in Australia buys ANZ Bank normally. Now, anyone who's done their research anyway, because they take their money and they just blow it up elsewhere. So all you want with the banks is very simple: just pay out the cash, keep investing in the business to cut costs, make it as efficient as possible, and just don't do anything dumb. And that's really the secret of banking and insurance anyway, is just don't do anything dumb.
Well, I mean, that's the argument, isn't it? It's probably meant to be boring, like bonds once were. Yeah. It's sort of hard to stuff up, and yet they always find new ways.
Well, that's perfect time, right? Because they should be utilities, and the return on equity should have utility-like return on equities, not the 17% and 80% that they used to have. Like, they're just processing businesses, so they shouldn't be earning exceptional returns like nearly 20%. They should be priced like utilities. There shouldn't be a real competitive advantage in these banks. They don't do anything special. The main advantage for CBA is just that it gets cheaper funding, and it has has the biggest deposit base in Australia, and that's what gives it its advantage. That's why the neobanks can't compete, because they just can't get that cheap financing. So yes, you want it absolutely simple, and that's why bank valuations, theoretically, at least until 12 months ago, had come down from the past. They weren't trading it as bigger ratios as before, and the return on equity is the proof in that. They've come right down, and they used to be even 14 or 15% for the non-CBA banks, and even they've come down now to below 10, and that pressure is going to continue. It's not going away. So they are sort of getting towards being utilities now, which is what they should have always been. In fact, one of the biggest giveaways of not to buy a bank is when the return on equity is rocketing because they're making a crazy amount of loans in a crazy environment, and usually a lot of those loans end up going bad.
There's a lot of questions that I feel like you've covered off just very well already, in terms of people have asked before what how long might this bubble last, and obviously it's very difficult to predict, and like you said, it might deflate slowly. There's others here talking about AI. NAB we've covered on as well. I'll just see if there's any others that might be of interest here, because it seems like we've covered off generally everything. There's a few thrown in that are not around the banking, but we'll just stick with the banking.
I think I should point out too, I think there's a question there's something about Macquarie's different exposure, and I certainly wouldn't compare Macquarie with the four banks. Like, they're very different businesses. And I think, if you get a GSE sort of period, like I would expect the four banks to perform better than Macquarie, because Macquarie is so hitched to financial markets. Like, it doesn't necessarily mean the falls are justified, but it's just when your main business is asset management, and corporate business. Like Macquarie is hit. It's done a lot of investments now in green technologies and all that sort of stuff, and they always talk about recurring revenue, but you've got to be really careful about recurring revenue, because recurring revenue can be recurring until it isn't. And when your business is based on fees, those fees can dry up very quickly because asset prices fall or valuations fall, or whatever. So again, I think, if you ask me, I'd probably prefer to own Macquarie for the next decade than the four banks, because it's well managed and at least it can grow. But I would expect it to be far more volatile through a cycle. There's a reason, although it's quite a different business today, there was a reason it got down to $18 during the GFC.
I was just thinking then myself that the banking fees were almost like the original subscription model, where you almost had no choice to pay them. But a lot of them have become much more competitive in that sense too, haven't they? In terms of no fee accounts, as long as you put all your money with them at the same time. We've reached the end of the webinar. We've gone a little bit over. There's been so many really good chats that have been happening in the side there as well. I'll get the YouTube video edited and uploaded onto our YouTube channel. In the meantime, of course, always remember that you can follow us on social media. One of them, of course, is Twitter, where we've got a very big following. It's definitely something we update a lot, fairly active. You can definitely ask questions and engage with us there. But if you're someone who subscribes to Intelligent Investor, which a lot of names I see in the comments there, it definitely seems that's the case. Or if you're looking to trial, definitely look at the trial offer that you can use. It's free for a period of time. The whole point is that all the articles and research recommendations that Nathan and his team write, you can actually comment and ask questions on those articles. So always, know that you've got that source, that communication link there. But Nathan, unless there's something else you wanted to cover off, thanks so much for joining us and making the time. I don't think we'll fit any more webinars in for the end of the year. So this probably is the last one.
Thanks, Tom, and thanks for the last webinar. But thanks everyone for their support, whether it's just on the webinars or the subscription business or the funds. Hopefully this bubble pops. I'd much prefer the crisis and the bubble popping, but I think we've got used to crises because of the GFC and COVID. But this one might be more subdued, but hopefully we'll get a lot more opportunities over the next couple of years and we don't have to put up with this anymore.
Excellent. Well, on that note, have a great rest of the year, and we'll see you back next year.
Thanks, Tom.
Thanks, Nathan.